Welcome to Protect and Grow with Chicagoland certified financial planner Tim Stearns of TJ Stearns Incorporated. Trust, respect, and results. TJ Stearns Incorporated focuses on comprehensive financial planning and benefits.
And welcome into the program. This is Protect and Grow Chicagoland Retirement with Chicagoland's certified financial planning professional, Tim Stearns, CFP. Here is your resource, ladies and gentlemen, for proactive guidance and perspective to uncomplicate the financial world and give you better, more efficient planning strategies so that you can accomplish your goals. And Tim, as we are closing in rapidly on the end of the year, it is time to execute on some of these strategies to make sure that we are in the best shape possible to end this year and move into the next.
Peter, you couldn't say it better. I mean, a lot of people don't realize that the current tax laws will sunset at the end of 2025. So if you haven't done so in this year, 2022, there's a good opportunity that you could miss out on. And we're talking about today, being proactive planning with looking at what your tax bill is. In other words, a Roth conversion, whether you have that opportunity or not.
Yeah, and there are ways to proactively manage that tax bill, although the default that we have been taught of defer taxes until retirement, Tim, is actually setting us up for the highest potential tax bill in retirement. And a lot of people have not thought about or encountered that second part, which is why we're going to be talking about strategies to manage and to reduce morally, legally, and ethically what that lifetime tax bill is in, during, and throughout retirement. It was the famous U.S. Court of Appeals Judge Learned Hand who said that anyone may arrange their affairs so that their taxes shall be as low as possible. We are not bound to choose the pattern which best pays the Treasury. It's not even a patriotic duty to increase one's taxes. So talking about today, the strategies where we can better control and minimize those taxes, ladies and gentlemen. One of retirement's largest expenses. And if you have questions or concerns, if you'd like to put a plan together to proactively manage and reduce your lifetime tax liability, give Tim Stearns, CFP, a call at 800-640-2256. That's 800-640-2256, 800-640-2256. Taxes, Tim, are a pain, a thorn in our side, but in retirement, really one of our largest known expenses.
Yes. And a lot of people say to me, in class or when we're meeting with people, well, won't my taxes be lower in retirement? This is after, at the beginning of class, I'll ask people, where do you think taxes are going? And they all give me the thumbs up that's going up. I've never had anyone in any of the states that we do our college classes say to us, oh, it's going to go down. So my point being is that why wouldn't we get ahead of it? If you do a income allocation plan, you'll see that you're basically going to be living off of what you currently are, whether you're working or not. Your property taxes don't go down once you retire. Your utilities don't go down, etc. So I try to, and we jokingly say in class, Nicor Gas isn't going to call you after you retire and say, well, thanks for your 50 years of service. We're going to cut your gas bill down in half. No, it's going to be the exact same. So we try to tell people, take a look at what your tax bill is. Everybody that I know comes in here after January 1st every year. They go, oh, shoulda, coulda, woulda with our taxes, right? So why not get proactive with it so that in retirement, you're not paying more taxes than you should? And just like you said, Learned Hand, the judge said, pay your fair share, but don't pay more. That's summarizing what he said, abbreviated, obviously. But that's an opportunity for us to get ahead of this. And we tell people, come in and see us. And we have excellent reports that will show them exactly what the cost of keeping a 401k or IRA forever and ever, what the tax bill will be. And we should break that down, Peter.
Absolutely. And Tim, in your classes, all of those thumbs up saying that taxes could be going up into the future. What do we know about the direction of taxes into the future? Is there any insight? Is there any kind of preview of what taxes could look like into the future?
I think at bare minimum, they will reset to where they were in 2017, where they were lower. And they're going to go back to the other levels that they were, the 12 becomes 18, et cetera. and goes on from there. So I tell people, why not? You have opportunities right here. Think about this. You have these years left to do a Roth conversion to avoid some of your taxes down the road. You have 2022, 23, 24, and then the end of 25 if they don't change something on us. So really, time is of the essence, so you want to make sure that you look at this and look at what your true tax bill is. So Peter, what I was going to do is I was going to take us through an example of the report that we do. Is that all right with you?
Absolutely.
Okay.
Yeah. Let's get to it so people can know how they can quantify, better understand, and begin to identify the strategies to control our tax bill in retirement. Tim, you've got several great examples to go over here.
Right. So I just took an arbitrary number and I said a married couple that has over $2 million in a 401k or IRA. Okay. They have $2 million. I'm going to assume the tax liability is about 22%. Okay. All years that they're in retirement.
That's where their income would put them.
Yes,
right?
Correct. Yes. I just set annual pre-tax earnings rate of around 4.25. Okay. And lastly, I said that there would be account expenses of 1.25. So breaking that down again, that's $2 million at a 22% tax bracket as we're taking money out of the IRA. What does that look like if we just keep things the status quo? You're looking at total taxes paid on your RMDs at the time of withdrawals, $546,738. Taxes paid on reinvested required minimum distributions of $198,603. And the taxes paid on remaining account value at death, which would be by your heirs and your beneficiaries, is $391,389 for a grand total of $1,136,730. Okay. All right. So that is if you keep a qualified account. So let's make things.
Tim, that's more than half of the current account value. We're in a 22% bracket, but when you compound it and grow it over the years from, as this illustration sort of assumes, from 62 to 90 years old, and just default and defer to the IRS's minimum distribution table, we will have paid over the course of our lifetime and then in our legacy more than half of the current balance in taxes.
That's correct. So you're looking at the fact that you have $1.1 million in taxes alone. So really about $900,000 of that money was yours. Okay. So now let's look at what if we did a Roth conversion of the whole $2 million today. All right. Then you're looking at $440,000 of taxes. So that's a savings of over $700,000 in taxes over your lifetime, up to age 90. Okay. So why wouldn't you at least look at this? I always tell people in class, I'm not advocating for people to take $2 million and do that, because that kind of throws people for a loop in their brain. Why would I pay all that taxes today?
Well, and Tim, if we converted over the full amount, we obviously would bump up into a much higher, significantly higher tax bracket than the 22%. We're talking about using these 4 years and trying to spread that tax out, correct?
Exactly. So you wouldn't do all this at once. I'm not advocating for that, and I tell people that in class. But why not nibble on the apple of taxes that is going to turn very sour down the road? So that's another reason to do it. At least take a look at what your situation is. I know in my family, I was told to put my money into a 401k, take the company's match, right, and defer taxes down the road. But nowadays, that's not looking like the greatest idea. And you look at all these baby boomers who have millions in their tax deferred accounts that they've never had the IRS take their chunk of. Why not get ahead of this and take a look at the ability to do some Roth conversions?
And many of those baby boomers and retirees and pre-retirees have never actually run the numbers to quantify how much that tax bite is going to be either. Tim, these reports that we are using as examples to discuss this important aspect in planning on today's program, you can run these for individual specific set of circumstances, their tax deferred balance, their tax brackets and rates, and you can show them and quantify for them what the likelihood of that tax bill is going to be, and then identify some of these proactive strategies with this particular example here, 62-year-old couple, $2 million in tax deferred assets, a tax savings over their lifetime, Tim, of $696,730. Is that significant enough to look at these kind of examples, ladies and gentlemen, to look at these strategies and see if it results in a tax savings for you?
I would hope everyone would want to see this, and this is, part of the things that we try to help people with, whether it be in our classes or people who come in to see us. At the end of the day, what is going to be my tax bill over my lifetime? The one thing we haven't even talked about is that third area of taxes, which is taxes paid on the remaining account value at death. How did we get to $391,000? I'll tell you real easily. The word is Secure Act, right? That is the phrase that is causing this. We have to, if someone passes away and we're a beneficiary and we're not the spouse, you have to drain these accounts within 10 years. So that is the tax bill that you're looking at when we have to take care of the qualified money over 10 years.
And we've got to take those distributions over that 10-year period. Tim, this actually does not include what those beneficiaries' specific income may be. They may be earning higher income at that point in time, and you add those 10 years worth of required minimum distributions on top of that, and it could be even more than what is illustrated here. But, bottom line, a $2 million account value at 62 in a tax deferred asset, we know there's a bill there, but many of us don't know what that bill may look like. Your software, your illustrations can help project out what growth rate we would like to assume on that, what tax rate we are in, any cost, fees, expenses, and then create that distribution plan, run the numbers, and show us what the tax bill is going to be if we default to the IRS's plan, or it runs some comparable numbers, assuming that we proactively manage that tax liability, and the savings can be substantial. So, ladies and gentlemen, again, if you would like to see those numbers and identify those strategies side by side specific to your situation, pick up the phone and give Tim Stearns, CFP, a call. These numbers are really staggering when we look at them, and he'll run them for your specific situation. 800-640-2256. That's 800-640-2256. 800-640-2256. Tim, I'm looking at a couple other examples that you've run here for a married couple age 65 with a $1.5 million account balance. The savings on that one over $400,000 for managing that tax bill proactively rather than defaulting to the IRS's plan. I see another example here that you ran for an individual, and he was already 70 years old with a $1 million account balance. Again, even though he was already right on the doorstep of those RMDs for himself, a tax savings of over $220,000. Really, Tim, the message here is to run these numbers for your specific situation and look and see what the potential savings could be if you manage this biggest retirement known expense proactively, if you find strategies to help you manage that tax bill.
We always talk about that in class, that number one, your biggest expense in retirement is taxes, and then comes medical expenses. So why wouldn't you at least explore it? If your advisor hasn't helped you do that, look at what your tax bill is going to be over your lifetime. Give us a call and we'll help you with that. A lot of that would have to do with having a plan, right? A taxation plan, and thank goodness we have a CPA on staff that can help with that. These are the things that we do here to make sure that our clients are educated. So who wants sticker shock when you're in retirement? No one. And your kids don't want it either. Your beneficiaries, whoever that might be.
Yeah. And Tim, you talked often on this program about the Protect and Grow written retirement income plan, that proprietary process that you take folks through there at TJ Stearns Inc. Is this illustration, this calculation and scenario where we get a better understanding of our tax liability part of that written retirement income plan?
Always. You have to have it. You have to know what your taxes are going to be in retirement so you can know how you're going to live. I mean, the last thing you want to do is think that you're going to live on, let's say, $100,000 a year in retirement, because the people say, oh, the kids will be out of the house will be paid off, etc. A lot of times they don't cut in the IRS or Uncle Sam, whoever you want to say, in their plan, right? And so you got to realize, when someone says to me, oh, I want to live on $100,000, I'll ask them, is that gross or net? Is that net of taxes? Because that's a difference, right? Mm-hmm. One of our slides talks about how if I had $1 million in my 401k, how much of that is mine, and we break it down. So these are things that you need to look at. And a lot of people, I think, are scared to see what that final bill is. And so we're happy to be the bad guy and show them it, and then show them a solution that will give them, some relief as to what the taxes could be.
Well, I think it's twofold, Tim. One is we have lived life and saved dollars under the teaching and the assumption that taxes will be lower in retirement. And then that compounded with the fact that I think we are adverse to paying, and none of us really enjoy paying taxes.
Right. And don't forget, we have inflation right now, right? Mm-hmm. So, I mean, what you have is probably not what you think you're going to get. The other problem you have is that, there's a Medicare surtax, right? With the amount of money that we're earning in retirement. So this would be another reason to do maybe some Roth conversions. If I'm in my early 60s, now is the time to be doing that. Maybe I've retired lately. You can retire and make sure that you don't put yourself where you're paying more for Medicare, and then your family and you are paying more for taxes.
Again, if you would like to run the scenarios, see the numbers for yourself, for your specifics and your situation, pick up the phone and give Tim Stearns CFP a call, 800-640-2256. That's 800-640-2256. Now, Tim, in current events and news, we do see that due to that inflation that you talked about, the IRS is actually increasing some of our contribution limits for next year. Yep. Something that we should take advantage of, despite the fact that these accounts might build up a tax bill, or is this opportunity that we could actually better control our tax bill?
Well, I mean, we always tell people you need to give at least as much into your 401k as the match, if you're lucky enough to have one. After that, you need to make some decisions. If you can, I would contribute to Roth 401ks. I would also contribute to Roth IRAs if you're underneath that threshold. But at the end of the day, things that can grow tax deferred, and then when I take it out are tax free, they rule the day. And that's what I would want. But if you have to do that, they're allowing you to put $2,000 more in 401ks. Take advantage of that, because you can do that in a 401k Roth. A lot of people come in here and they go, I don't know if my company does that. I tell them, when we're done here, go and call HR and ask. Those are great examples. My son is out in the business world now, and the first thing I told him was sign up for a 401k Roth. Can you imagine the power a baby boomer would have with their 401ks if they had a Roth their whole lives? They're notorious savers, right? Thank gosh. A lot of them don't have pensions, so they knew the need for that. The pensions were kind of taken away from them in the middle of their careers. So why not look into opportunities where you can do a 401k Roth?
Again, these are opportunities that the limits will be changing and increasing next year, but to see how that applies to you and your situation, and to take full advantage of every tax opportunity that we have, consult with an experienced, qualified professional. Tim Stearns will give you that perspective. He is a certified financial planning professional. Tim Stearns CFP does make his time available to you, ladies and gentlemen, for that individual specific guidance with no cost and no obligation. Just pick up the phone and give a call, 800-640-2256. That's 800-640-2256. And Tim, although we might not love We certainly don't. In fact, enjoy the volatility that we have seen in the markets this year. There can be opportunity amongst crisis. And because of these down markets and down retirement accounts, it may be an advantageous strategy to consider the Roth conversion now, maybe more than ever.
Well, I had a gentleman who called into our show many years ago. He did that in 2008, and he was sitting very pretty on top of a huge Roth account because he rode the 13-year bull market. So yes, that is a great opportunity right now. You know, when life gives you lemons, make lemonade type of analogy. You know, that's a perfect way to do that, is to take some of that money and that's down so much. You know, we're seeing ranges of, you know, bonds are down 16% to the NASDAQ being down 36%. Great opportunity to maybe try to ride this thing back from the brink of being, you know, desperate and try to make it so that it builds into a nice Roth IRA for yourself.
Well, and think of it this way, I suppose. If we had $20,000 or so, you know, pick an amount that we could pay the taxes and be done with them forever. Well, now that the account balance is down, we get to convert over a larger total percentage of our yet to be taxed tax deferred account. And then a larger percentage of our total wealth recovers when the market eventually turns around tax free. So maybe an advantageous time to consider that. Although I do also understand, Tim, that it's a little bit of pouring salt in an open wound because we're down in value and then we proactively have a tax bill to pay. So must be considered on an individual basis, which is exactly what you help people do. And you run the scenarios with the software and the illustrations that you have to show them their specifics and quantify the numbers, show them what the likely tax bill will be if they defer and default to the IRS's plan, or if they are proactive in enacting their own plan. And spoiler alert, the IRS's default plan, Tim, is rarely ever in any of our best interest.
That's a nice way of putting it. It stinks is the better way to put it, I think. Yeah. So I ask people, do you want to pay on the seed or the crop? To summarize it real easily. So I would tell people that if your portfolio is down, maybe do some Roth conversions. What else is down? Income tax rates, right? We have another 4 years of this. So why not look at this opportunity for what it's worth and run the reports? We can customize anybody's report that they want. Just give us a call.
800-640-2256. That's 800-640-2256. And we covered a little bit in the last segment of the show, but there are some year-end reminders for taxes as well: tax loss harvesting, phantom income and gains, Roth conversions. You know, if we want to take advantage of 2022, you've got to do it before the end of 2022. And Tim, a lot of these financial institutions have put deadlines in early December as far as getting the orders and the paperwork in. So right now is the time. And then finally, RMDs and QCDs, those things, as well as contributions, they all need to be done before the end of the year. Make sure you're executing earlier rather than later. It's planning. It's about being proactive, and procrastination is no one's friend.
Right. I agree with you, Peter. That's why I love that people are, you know, we're getting a lot of people come into our class because they are worried now that the market has taken a hit. And and to that end, we are trying to help them see through it, you know. So having stop losses is key. Doing some Roth conversions to circumvent taxes down the road for you also helps you with the cost of Medicare. There's a lot of things that can happen that are good, even in this down market.
Also can help with the amount of Social Security you actually get to keep.
That's a true story. That's exactly right.
So many aspects.
Right. And that's why I would hope people give us a call. And then obviously we have our book, Income Allocation, that they can see why there is a need for a plan. You know, not having a plan is having a plan, and going about it, you know, I'm hoping for the best does not work in retirement.
Yeah, just usually not a very good one to just hope without the true plan in place. And that's why Tim Stearns, CFP, offers to help you put that together, ladies and gentlemen, quantifying things like market risk, like fees and expenses, like tax liability, and then showing you the strategies that can be more effective and efficient in achieving and accomplishing more of your financial goals, allowing you to keep more of your money. Pick up the phone, give a call for that written retirement income protect and grow plan through TJ Stearns Inc. from Tim Stearns CFP. 800-640-2256. That's 800-640-2256. And for the first 10 callers to the program, a copy of that book, Income Allocation, if you have at least $500,000 or more saved for your retirement. Again, if you'd like that book, or if you'd like the complimentary time with a certified financial planning professional to design your own protect and grow proprietary retirement plan, pick up the phone and give a call now. 800-640-2256. That's 800-640-2256. Tim, as always, we appreciate the time and guidance here on the program. Thank you for being here as our resource.
It's all my pleasure, Peter. Thanks.
Tune into Chicagoland Certified Financial Planner Tim Stearns' full radio program and visit tjstearns.com for many valuable resources, including other great episodes of Chicagoland Retirement. Be sure to subscribe.
Securities offered through TJ Stearns, a registered representative of Crown Capital Securities LP, member FINRA SIPC. The information presented on this program is provided for informational purposes only without warranty of accuracy, completeness, or suitability for particular purpose. This program is not intended to be and does not constitute financial, investment, legal, or tax advice. This information is general in nature, not specific enough to be construed as advice. You should not make any decision based on the information presented on this program without independent consultation with an appropriately licensed professional or competent advisor. Investment in securities or the market involves a potential risk for loss of principal. Trading, therefore, may not be suitable for all listeners. Annuity guarantees are based solely on the financial strength and claims-paying ability of the issuing company. Withdrawals of growth from annuities may be taxable as ordinary income in the year it is taken. Individuals should review contracts for specific details of the product's features and costs.